everyone, and welcome back for another deep dive with us.
Huh.
Today we're going to buckle up for a wild ride through the history of universal life insurance.
Oh, yeah.
We're going way beyond the surface here
Absolutely.
to see why it's had such a roller coaster of a reputation.
It's a fascinating one for sure.
Yeah. Have you ever heard of a life insurance policy that almost got taken down by interest rates?
That's a new one.
Yeah, you heard that right.
It might sound strange, but the story of universal life is very closely connected to how the economy's doing,
Right.
especially things like interest rates and the stock market.
Okay, so to really get this, we need to rewind all the way back to the early 1980s.
Okay.
When the very first universal life policy was introduced, traditional universal life.
Yeah.
But here's the thing, it launched right as interest rates were going absolutely bonkers.
Oh, yeah, that's right. We're talking like historically high interest rates here.
Wow.
Think about like the prime rate, the rate that banks use as a benchmark.
Right.
It was soaring to double digits for 6 years straight.
Oh, wow.
It even hit a peak of 20.5% in 1981.
Really?
Just to put that in perspective. Today's prime rate is hovering around like 3.25%.
Wow.
So that's a massive difference.
Yeah, 20.5%. That's almost hard to even grasp nowadays.
I know, right?
So how did these crazy high rates mess with traditional universal life?
Well, you see, traditional universal life policies are designed in a way that their growth is tied to those interest rates.
Okay.
When rates were that high, the projections for these policies looked incredible.
Oh, really?
People were seeing illustrations with these huge potential returns.
So everyone just thought they'd hit the jackpot.
Exactly. But you have to remember, those were just projections, not guarantees.
Right.
They were based on the assumption that those sky-high rates would just last forever.
Oh, so it's like assuming the stock market will only go up forever?
That's a great analogy, unfortunately, with the traditional universal life. Interest rates didn't stay high.
Right.
After 1984, they began to fall, and they kept falling. And as a result, the actual returns on these policies ended up being much lower than those initial projections.
So people were expecting this huge return and ended up with what, just disappointment?
Disappointment is putting it mildly.
Oh, no.
Many people felt misled, and it led to lawsuits
Yeah.
and really damaged the reputation of universal life.
So it wasn't like the actual idea of traditional universal life was bad.
Right.
It was more about how it was used and the unexpected drop in interest rates.
Exactly. Imagine you have this powerful sports car like a Porsche 911 Turbo,
Okay.
but then you slam it into reverse while going 150 miles an hour.
Oh, wow.
It's not the car's fault it breaks down, right?
It's the driver.
Exactly. It's the driver's fault.
So it sounds like the context in which traditional universal life was sold
Yeah.
and these crazy interest rate changes really led to its downfall.
Absolutely.
But is there a chance it could make a comeback? After all, interest rates are at historical lows right now?
That's a really interesting question. If interest rates do start rising again,
Yeah.
those traditional universal life policies could actually end up outperforming the projections that we have now.
Right.
Of course, no one can predict the future,
Right.
but understanding this historical context,
Yeah,
it gives us a much better perspective on the potential of these products.
for sure.
And it reminds us that even these really complicated financial products are still connected to the bigger picture of the economy.
Yeah. Now, while traditional universal life was battling those interest rate troubles, a new type of universal life emerged in the 1990s.
Oh, yeah.
This was variable universal life, or VUL, and it brought a whole new set of complexities to the table, didn't it?
That's right. And just like traditional universal life was tied to that roller coaster of interest rates, VUL was linked to the stock market,
Right.
which, as we all know, has its own ups and downs.
Yeah, for sure. And this was during the 1990s, right?
Yeah.
When the stock market was booming like crazy.
Uh,
Everyone was talking about making money in the market.
Precisely. It was the era of the dot-com bubble.
Oh, yeah.
Investors were just pouring money into tech stocks.
Right.
And for a while, it seemed like everyone was getting rich.
Yeah.
And this created a huge demand for financial products that could, capture that growth.
Yeah.
And VUL stepped right in to fill that void.
So VUL was basically designed to ride that wave of the stock market boom.
Pretty much, yes.
What could possibly go wrong, right?
Well, there's that saying,
Bags up.
what goes up must come down.
Right.
Just as people overlooked the possibility of falling interest rates with traditional universal life,
Mm-hmm.
many investors in the 90s didn't fully grasp how volatile the stock market can be.
So they were so focused on the potential gains.
Right.
They didn't really consider the risks.
That's a pretty common pitfall, unfortunately.
Yeah.
People tend to get caught up in all the excitement of a bull market.
Yeah.
And forget that markets can and do correct themselves.
Of course.
And that's exactly what happened in 2000 when the dot-com bubble burst.
Okay, so remind me what happened with that dot-com bubble. It was a pretty big deal, right?
It was a major turning point, the NASDAQ Q,
Right.
which is heavily weighted towards those tech companies. It peaked in March of 2000 at over 5,100 points.
Wow.
Then it all came crashing down.
Oh, no.
It lost over 75% of its value in just a couple of years.
Wow, 75%. So what did that mean for people who had put their money in VUL policies?
It wasn't pretty. Remember, VUL ties its returns directly to the performance of the stock market.
Right.
So when the market tanked, the cash value of those policies decreased significantly.
Oh, wow.
And here's where things get even trickier.
Okay.
Even though the cash value is shrinking,
Mm-hmm.
the costs of the policy, like administrative fees and death benefit charges,
Right.
those kept adding up.
Oh, no.
This combination could lead to like a really rapid depletion of the policy's value,
Wow.
leaving people with way less coverage than they thought they would have.
It sounds like a double whammy. The market's down and you're still paying these fees.
It was, and it really highlighted how important it is to understand the risks that come with market-linked products,
Right.
like VUL.
Yeah.
It also emphasized the need to regularly review your policy, just to make sure it's still meeting your needs,
Right.
especially when the market's being all volatile.
So both traditional universal life and variable universal life had their share of challenges.
Definitely.
What did the insurance industry do to try and address those issues?
That's a great question, and it leads us to the next chapter in the evolution of universal life.
Oh, okay.
Index Universal Life, or IUL.
This sounds interesting. What's different about IUL?
Well, IUL was designed to address some of the concerns we've been talking about.
Right.
It aims to offer a more balanced approach,
Okay.
sort of like a middle ground between the stability of traditional universal life
Mm-hmm.
and the growth potential of VUL.
Okay, walk me through this. How does IUL actually try and achieve that balance?
The key difference is in how IUL links its cash value growth to the market.
Okay.
So instead of directly investing in the stock market like VUL,
Right.
IUL links its returns to how well a specific market index is doing,
Oh, okay.
like the S&P 500.
Right.
But here's the important part. There's usually a cap
A cap?
on the maximum gain you can earn in a given year
Okay.
and a floor to protect you against losses.
Oh, interesting. So even if the market does really well, your gains are limited to a certain percentage.
Exactly.
Yeah.
That helps to manage expectations
Right.
and prevent those unrealistic projections we saw with traditional universal life.
Okay, that makes sense. And what about the downside? What happens if the market takes a nosedive?
That's where the floor comes in.
Okay.
IUL policies typically have a guaranteed minimum return,
Right.
often 0%,
Okay.
which means your cash value won't decrease even if the market goes down.
So it's like having a safety net, but you're still participating in the potential growth of the market.
That's a great way to put it. It's like having a seatbelt on
Right.
while riding that financial roller coaster.
I like that.
You still get to experience all the ups and downs,
Yeah.
but you've got that extra layer of protection.
So it seems like IOL was designed to learn from those past mistakes of traditional universal life and VUL. But even with these safeguards, IUL is still a pretty complex product, right?
Oh, absolutely. It's not like a one-size-fits-all solution.
Right.
And it's really important to understand all the little details.
Yeah.
There are still fees and expenses involved with IUL, and how well it performs can really vary,
Okay.
depending on things like which specific index is used and the actual terms of the policy.
Makes sense. So it seems like we've gone on quite a journey today.
We have.
We've seen the ups and downs of traditional universal life.
Yeah.
We explored all the complexities of variable universal life.
Yeah.
And we've learned how index universal life tries to offer that more balanced approach.
Right?
It's been a wild ride through the history of universal life.
It has.
But what's the main takeaway for our listeners?
I think the biggest takeaway here is that universal life in all of its different forms
Yeah.
is a really powerful financial tool.
Okay.
But like any tool, it needs to be used correctly.
Right.
And with a full understanding of both its potential benefits and risks.
Right.
The history of universal life, with all of its twists and turns,
Yeah.
really highlights how important it is to do your research,
Mm-hmm.
ask questions,
Yeah.
and make sure that any financial product you're considering
Right.
actually aligns with your own individual needs and goals.
So it's not about saying that one type of universal life is inherently good or bad.
Right.
It's about understanding how it works,
Exactly.
the risks and the potential rewards.
Now remember, the financial landscape is constantly changing.
Right.
What worked in the past might not be the best solution for you today.
Yeah, for sure.
That's why it's so important to stay informed.
Oh,
Be proactive.
yeah.
And seek guidance from trusted financial professionals who can help you navigate all of this.
Those are some really great points. It's been a fascinating deep dive into universal life today.
And it has.
And I hope everyone listening has gained a better understanding of its history and how it all works.
Yeah.
So as we wrap things up, let me leave you with this thought.
Okay.
Knowing the history of universal life and all of its intricacies, what factors would you prioritize before investing in any type of life insurance policy today? What questions would you ask?
Yeah.
And what safeguards would you look for?
That's a great question to think about.
Yeah.
It's a reminder that knowledge is power.
Right.
And taking the time to educate yourself is the best way to make informed financial decisions.
Absolutely.
That'll benefit you and your loved ones in the long run.
Couldn't agree more. Well, that's it for our deep dive into universal life. Thanks for joining us on this journey.
Thanks, everyone.
And until next time, stay curious.